Hello, everyone, and a very warm welcome to today's Major Markets Update for Wednesday, September the 18th, 2024. Well, of course, the main news was the Federal Reserve's interest rate decision by lowering it with 0.5 BPS base points. Shocker, is this a emergency rate cut? Are they behind the curve? And has their decision changed our view of the market? So far, that is a resounding no. As you remember, we were looking for the market to top out and then start to decline. Well, we got a spike higher today, which could still count as a fifth wave on a smaller time frame, and we should now be declining. So honestly, nothing out of the ordinary here, except maybe the spike was a little bit unexpected, could even be a irregular B wave. But in the end, we closed lower. And as you know, we mostly go by closing prices because closing prices are the most important price of the day once the market opens. We use the Elliott Wave. We can never be always correct because we're dealing with a complex system, and complex systems cannot be forecasted correctly all the time. Very simple. So you have your rules. And of course, you have to know that you need to use stop losses because stop losses are very important, and never put all your nest eggs in one basket. Okay. And of course, many ways for you to use what I do, and please use that to your advantage. Don't shoot yourself in the foot. And then let's go straight to the charts. There's some more good stuff about compelling reasons why you should stay in the market for longer periods of time and not for brief periods of time, and what it takes to go back to break even when you get big losses. As you can see here, 50%, you need to gain 100% to go back to break even. 70%, you need to gain 233%. Wowzers. And last but not least, of course, the charts. And we start off in alphabetical order, the Dow Jones. We thought yesterday it already topped, well, we got a little bit of spike higher, but a lower close. So far, we have not broken below any warning levels. We could raise even the warning level for the very short term, which could be right there. Yesterday's close, we haven't even, or a low, I mean, I haven't even gone below it. So I'll put it at Monday's open. I think it's a better one. And as you can see, we haven't broken below anything. But I still believe that lower prices are to be expected. Contingent, of course, on holding now below today's low. Okay, if we break above today's high, then this is already underway, and we have a very, very, very shallow B/2 wave. It is still possible. I want to point out that what we show here is the typical 50 to 62% retrace for a B/2. Retraces can also be anywhere between 38.2 and 76.4%. They can also be between 23.6 and 88.6%. You just don't know beforehand where exactly it's going to bottom. Of course, wave 2 can be anywhere between 99.9% retrace and a 0.1% retrace. The market decides. So anywhere between that range is where you expect a bottom. Okay. It is pretty much a bell curve for those that know a little bit of statistics. A bell curve is a frequency distribution of how often a certain thing happens. It's the same as, for example, with height, not necessarily with body weight anymore, because 70% of the people are now overweight in the United States. So that bell curve is shifted, but pretty much height is, of course, most people are about 5'8". If you look, of course, gender specific, male versus female, and those are the only two sexes there are, then you have, of course, most people at an average height of about 5'8", 5'10", I guess. And then, of course, you get the bell curve with less and less people being taller and taller and less people being shorter and shorter. Not everybody is 4 foot. Most people are not, right? Most people are not even 5'2", not even women. So that said, that's the same, of course, that bell curve distribution. That's why the market is probabilistic on where to expect a low. You do not know beforehand. So if most of the lows occur at a 50 to 62% retrace, that's then this thicker part. But we also know that, of course, some retraces are shallower, some are deeper. So, of course, this box, the wider it gets, the more likely you're going to catch the actual low of the decline. But we want to be as specific as possible with a 95% accuracy. So these are our target zones. All right. This is where we are looking at. Again, we made a new all-time high for the Dow Jones. Can't say that's bearish, but again, we are still missing, in my humble opinion, some waves higher. Could this be all of wave C of 505? Of course it can be. Yes. So that's why we have our warning levels in place. So for now, I'm going to look lower, somewhere around, I would say, 40,500 plus or minus 500. 40,500 plus or minus 500 seems to be a very logical target for this B/2 before C/3 to 43,000 kicks in. Contingent on holding, of course, above our warning levels. These are the two wave counts we are tracking for the NASDAQ 100, the alt and the preferred. Again, the NASDAQ 100 is not making new all-time highs. Clearly, the Dow Jones is. So we have two different indexes, two different animals, two different wave counts. The Dow Jones is here. The NASDAQ is here. So this is an entirely different approach to this index. Yes, we're back above the moving averages, but I cannot discern between the alt and the preferred wave count yet. We can say, all right, it's preferred, but honestly, these are just 50-50 at this stage. That's really all there is to it. So I think we're going to go lower for at least this B/2. And if we break below the September 6th low, we're going to go much lower. This is really a high-level overview of this index. Okay, this is so far where we are. I still think we're going to bottom somewhere around 1900. That is my initial thought. But again, we haven't even, well, let's raise that warning level for the bulls a little bit here. So we're going to put it there. So we've just done that one. Okay, just done that one. We're right here on that cusp. And let's then raise, I think, the warning level for the bulls a little bit more because we've gone a little bit higher. And let's raise this one all the way to that one as well. Okay, so we're going to raise it. Why? Because we made a higher high. So I don't know yet if this is a B/2 or if it's this in green, right? If it's either red or green. And the alt count, preferred versus alt, we'll have to see how that's going to transpire. Of course, the A1, B2 in red is, of course, looking for much lower prices, right? And whereas this one is for looking for slightly lower prices. Okay, so this is just a big picture overview. But again, we were looking for completion of the rally that started September 6th low. We're looking for that completion. And I still believe that about 19,000 plus minus 100, 200 should be on the table. So we can then draw a little bit of a box here as well. As you can see, we're going to use, so this is anywhere between 23.6 to 76.4%, right? So this is your big picture target, but most of the time we should bottom out somewhere there, okay? That is what we're going to look for. And that's why we say somewhere around 19,000 plus or minus 100, 200. Okay. So, and from there, we could then target C/3, for example, as I've shown also for the semiconductors, which I will show in a moment, for a potential more protracted B/2. And this is A, and then this is B, and then this is ABC. So a very complex B/2 wave. Okay, for now I prefer to look lower, contingent on holding below today's high. And you can see that was the second warning level for the bears, and we've breached it slightly, but absolutely did not close above it. Because otherwise, again, as we've shown here for the semiconductors, nothing new is then that we have this more protracted B/2 in red. So far, we've topped right here in this blue B/2 target zone. So nothing out of the ordinary. Okay. So the warning levels for the bears have only been breached for the second level, which is in gray, not the third or not the fourth level. So this is still the preferred wave count, honestly, that we have put in a larger top, but that is more of a short-term insight. And we need to hold, of course, the September 6th low. If we go below that one, I think we have a deeper decline on our hands. So for now, we're still a little bit stuck between a rock and a hard place, a little bit in no man's land here. But so far, this wave counts is working out well. If we stall at around 4,700 and then break above today's high, we're going to look for this 5,600. If we break below 5,600, or what is it, 4,500, the September 6th low, I think we can look for the high 3,000s. So for now, the semiconductors is also the least favorite index because it's the less clear. These are the two wave counts we're tracking for the S&P 500 that we would be in this green B2. Today's intraday high doesn't take anything for this wave count off the table. Still looks good as 5 waves up. And now in this B/2 down to about 5,500, I would say 5,525 plus or minus 25, somewhere around there. And then the C/3 contingent, of course, on holding above the September 6th low. We go below that one, then we have to reassess and bring this wave count to the forefront, where we then have completed a protracted B wave. And that protracted B wave was then, kind of irregular, but we almost did not exceed the recent all-time high from July. So I think then we can go back to about 5,100. Okay. If we do that, then we have to break, of course, below September 6th low at 5,402 with a serious warning below 5,500. Okay. Still very possible, this one. So this one looks lower, considerably lower than this one, but both look lower. And so far it's been good because we went lower. Yes, we had an intraday stab higher, but again, I prefer closing prices to personally base my trades on, as well as my analysis. Okay, because you can use closing prices to count waves pretty nicely as well. So we had 9 waves up here on a closing basis for this A, 3 waves lower for B, and then again 5 waves lower, which just pretty much went straight up, right? This is straight up. And this is the first down day pretty much since September 6th. So nothing out of the ordinary, really. Can we have a down day after 1, 2, 3, 4, 5, 6, 7 updates? Of course we can. So again, nothing out of the ordinary here. I have 0 warning signs that a major top is in place that will require much lower prices. IWM also made a new uptrend high. I still believe this can move higher into the 240 zone, potentially as high as 250. But we might have a more protracted wave C of COB. Okay, this still looks pretty good to me. And the warning levels for the bulls have not been recorded correctly by stock charts. There we go. I think that was what I was looking for. So, and then we're gonna move this one up here as well to there. Okay, now we're talking. So, okay, now we're talking. So I've raised the warning levels for the bulls. The first one is at about today's low, about 218, which was also about yesterday's low and of course Monday's high. And the second warning level here is about 215-ish. As you can see, that's where the 20-day simple moving average is, as well as the 50. It is, of course, the low here. It's the low here. And we broke above it here for a, I would say, fake breakout, but it was still a breakout nonetheless. And of course, we have 210-ish. And then here, the final low is, of course, September 6th. Go below that one, and this is going to be less likely. And then we have to change our point of view completely. That's that one, not this one. Let's move on then to market breadth. This is the bullish percent index for the S&P 500. It continues to rise. So that is in essence not yet bearish. So I've looked at different instances where we have a strong reading for the bullish percent index. And yes, we can get close to a top like here and like here and like here. But every time that we saw a decline, it continued to higher prices, except of course for 2022. And every time we go below 50 and back above 50, it is a pretty decent buy signal. But again, I have 0 indication that the top is in place. We still have 75% of all stocks in the S&P 500 on a buy signal, which is pretty strong. And a decline below 70 would be a good topping signal. However, the AD line continues to march higher. It made a new all-time high yesterday. And essentially, bear markets do not start with a new all-time high. Yes, we can, of course, have, and I mean multi-year bear markets like 2008 and 9, like that stuff. Okay, otherwise, you would just get a decline within an ongoing bull market. But a new AD line high is often not a recipe for the start of a massive bear market. Yes, we can get, of course, pretty steep declines. There's, of course, no guarantee. But again, you can see how these declines have then been gobbled up. That's the same one. Let's move on then to the McClellan oscillator for the S&P 500. It's at 15-ish. It's not really great. It's still positive. It's not really great. And the summation index as such might start to show this negative divergence for a bigger top as well, so to say, right? You get sometimes these divergences on the RSI 5 signaling a bigger top. So this one is a little bit less bullish. You know, on every window we can always find a smudge, so to say, but I have no sell signal. Okay, instead we have made not even a sell signal here, which got very close and then recovered. So we can have some negative divergence here. Okay, that is what we're seeing there, but it's not even confirmed. And that's neither always directly the end of the world. So I'm going to take that one away. I'm going to also take this one away because we can have sell signals, whereas the market moves higher. But it is a bit of a warning signal. So this one is warning us a little bit. And then the last one we want to check is the PMO buy sell signal. I don't think it's been updated yet. It takes a couple more hours. That one was on a nice buy signal since mid-September, and so far remains on a buy signal. Okay, so neither here do I have the sign for a top being in place. So did the Federal Reserve derail the market? No, not really. I think we're so far still on track with our preferred wave count that we were looking for a top soon. And I think we got that one in, and that we're now looking for a pullback. Today's stab higher was definitely a bit unexpected, but can't forecast everything 100% correctly. But just look here at the Dow Jones. It's above the 10, the 20, the 50, 200-day. All of them are rising above the Ichimoku cloud. It's a 100% bullish chart. And honestly, this chart still looks incomplete in the sense of we're lacking a extra wave, at least to 43,000 for this green sea of red 5 of blue 5 for this expanding ending diagonal. And an expanding ending diagonal, 5 is larger than 3 is larger than 1. So we're still kind of off, and I would like to see a tag of this upper trend line. Okay, NASDAQ 100 still remains more modeled. I still think we can see lower prices. If we stall out at around 19,000 plus or minus 200, potential as low as 18,700, we can still break higher and target again the 20,200 level, which would close this gap open here. Wouldn't surprise me if that's the case. If we break below the September 6th low with a serious warning below 18,500, we can target 17,400, potentially into the 16,000s. Okay, so again, the NASDAQ and NASDAQ 100 as well as the semiconductors don't look as bloomy and as nice as the Dow Jones and the S&P 500. That is my assessment. Same for the semiconductors. We did top here in this blue B2 zone. So we can fall back here to about 4750, make it 4700 plus or minus 50, and then rally back above today's high, which would then allow for a more protracted red B/2, which can target into the 5700 zone. And if we drop below the September 6th low, I think we can look for the high 3000s. S&P 500 as well. Once again, the ending diagonal is still the preferred scenario, still looks good, probably back to about 55.25 plus or minus 25. And then we can allow for higher prices contingent on holding above the September 6 low. If we don't hold above the September 6 low, we can go as low as 5,100 once again. I know some people have counted this as a 1, a 2, a 3, a 4, and a 5, which still would suggest we're going to revisit somewhere around 5350 plus or minus 50. That's a third alternative. It's all a bit how you interpret this, though I don't find this decline in line at all with the previous 1-2 setup, which was just a one-day affair, and this was a whole week, and the decline here is way out of proportion for this one, but it's okay. It is possible, but just a very, very low odds alternative in my humble opinion. To be determined for now. I guess both options are looking for lower prices, and that's what we pretty much have been looking for over the last 2 to 3 trading days. IWM made a new uptrend high. I still think it can go higher, contingent on holding above the September 6 low. It will probably be a lot of whipsawing, as it has been over the last year pretty much. And again, bullish percent index still looks healthy. 75% is bullish, in my humble opinion. Now, I do notice that larger tops happen when we get really overbought into the 80s. We're not there yet. So even then, we did see declines that eventually led to higher prices. AT line made a new uptrend high and all-time high yesterday. That's neither bullish. Yes, we can have steep and big declines from, of course, all-time highs, just as we saw here in 2015, we saw here in 2018, we saw here in 2019-20, we saw here in 2021, but all of them eventually led to higher prices. I would like to see negative divergence, as we saw in 2007, as we saw in the 1970s, as we saw in the 1920s as well. Meanwhile, the summation index of the McClellan oscillator is still positive, but declining. Do want to point out that negative divergence is not often a good signal for a top. Just as we saw here, for example, here you see this negative divergence, and what did we get? Continued upside. The market just might need to take care of some overbought business. However, the summation index has now potential negative divergence set up on its RSI 5, meaning we're having declining strength. But again, that doesn't take away from the fact that we would see maybe a multi-day decline and then higher prices again. All right, this is not a signal of a massive major top, so to say. This is not the can all do all. This is the final arbiter of all tops. Not at all. It just shows like, okay, well, maybe this is indeed a first wave, a little weaker. We're going to get a sell signal and then eventually a new buy signal. Okay, but it remains on a buy, and we just want to cover our bases, as also the PMO is so far still on a buy signal, and it's been correctly so over the last 1, 2, 3, 4 days. So far, so good. All right, that's all I have for today. There will be no update tomorrow. I am unavailable. And again, lower prices for the short term are the preferred path, contingent, of course, on holding below today's intraday high for all indexes we've covered. Take care, trade safe, and I'll see you all later this week.